Welcome to the Corporate Treasury 101 podcast. In this first part of our interview, Stefan M. Ciesla, co-founder at Ayora, and Gordon McKenzie, CTO and co-founder at Ayora, discuss capital management, why it is important for companies, and much more. Stefan brings his expertise from his previous roles at FIG Corporate Finance and as Chief of Staff at Bankable, while Gordon McKenzie has a background as a clinical entrepreneur at NHS England. Together, they bring a very interesting blend of knowledge around working capital management and technology. Our conversation with them was truly captivating, and we hope you will like it as well. In the episode of today, expect to learn what is working capital management, why is it important for companies, what are the solutions on the market that can help corporate treasurers in the management of their working capital, how can fintech and startups help in that field, what could be the role of AI in working capital management, and what is the future of working capital management and the solutions out there. And of course, like always, much more. If you enjoyed the episode, please consider leaving us a review on your favorite podcast app. Your support means the world to us and helps our podcast thrive. Last but not least, we started the AI Treasury Insights newsletter, a bi-weekly 3 to 5 minutes read that covers what is happening in AI in Treasury and how this technology will change the way we do corporate treasury. Follow the link in the description or simply type in your browser corporate-treasury-101.com/newsletter. With all that being said, please welcome Stefan and Gordon.
Stefan, Gordon, thank you so much for coming on the Corporate Treasury 101 podcast. Great to have you. Super excited to dig into it. We've touched on working capital management in the past on the podcast. Guillaume explained it to me really well, but that was a bit of a time ago now. So could you start off by just taking us through what working capital management is and why it's important to companies?
Yeah, sure. I mean, if you were to kind of try to summarize this in a relatively simple way, it's really a set of processes that are ultimately aimed at maximizing cash flow. And I think if you kind of want to go a little bit deeper, some of the key aspects would probably include managing your inventory and customer billing and collections to kind of realize cash inflows, and then accounts payable to essentially optimize the timing of cash outflows. And why is it important? Well, it's I guess it's generating cash is the bread and butter of every company, and that's the ultimate goal. So a well-designed working capital management process helps companies to maximize the cash that they generate organically, and it, all else being equal, should lead to a lower requirement to access external financing, which is more expensive.
So it's like making sure that the companies manage their inflows and outflows and balance it correctly. I remember there was short-term versus long-term in that as well. Is that is that how timeframes work? Or because cash can be, money's coming in and out on a minute-by-minute basis in a lot of companies, right? Are you really looking at that level of detail, or is it on a day cycle? What is it? How does that work?
Yeah, I guess it depends on the company. Many companies might look at working capital management on a, let's say, a weekly basis, and sometimes daily. If you have a very fast cash cycle, you might look at it intraday as well. I guess, if you think about a balance sheet, all the assets which are classified as short-term assets and all the liabilities that are classified as short-term liabilities, usually that means less than 12 months, are typically included in working capital. And I mentioned receivables, inventory, payables, but there are also other aspects to it. And a lot of them are dependent on your business model.
I remember this 12-month mark thing that you mentioned when you taught it to me the first time and to everyone else. So what's the role of a treasury department specifically in that process? Company?
Great question. Again, I think it slightly depends, but typically treasury plays an oversight role, and they will work very closely with teams that kind of manage each strand of working capital. So for example, they will often interface with colleagues in credit control or accounts payable or procurement to make sure that all these processes are done in a timely manner. And I think that's important because treasury is essentially the function that has the broader perspective and the broader view of this. And they also understand how all these processes ultimately tie back to financing of a company.
Okay. And we've been through a lot lately, right? Over the last couple of years. We had a pandemic. We have quite a changing and evolving macroeconomic environment. I'm thinking about the Russia-Ukraine war, the commodity prices going over the roof. Overall, the market is more and more uncertain and volatile, right? So how should Treasury and actually finance professionals, because I don't think only Treasury is impacted by this, right? How do professionals should look working capital management now?
Yeah, this is a very interesting question, and it's very topical. I think if you look at the current macro environment, in totality, this leads to essentially cost of capital increasing. And if you think about it that way, then managing your working capital in an efficient way is essentially a way to reduce your financing costs. As I mentioned at the beginning, to the extent you can maximize cash on hand for your organic operations, you don't need to access as much external financing, which in the current environment is only going up.
Yeah, it's a very good point you make here. So if that allows you to have cash more easily accessible, you don't have to borrow them at amazing interest rates going over the roof, right? So you can fund your activities yourself and not go to the banks charging interest because of the environment, right?
Absolutely.
Do you think it's a trend that is meant to continue, or is it just once in a lifetime?
Yeah, great question. I'm not an economist, but I take a keen interest in this. I think it's probably very difficult to foresee. And, some of those factors that impact the current macro environment that you mentioned are probably, well, we hope, temporary in nature. So, with some of the geopolitical pressures easing off, hopefully that should also lead to, for example, energy prices coming down. But at the same time, this is a pretty big question that many finance professionals pose to themselves right now. Because if you think about what's happening around the world, around some of the trends like deglobalization, frictions in supply chains, that doesn't necessarily need to go away. With, for example, hopefully the war in Ukraine ending as soon as possible. And if you think about deglobalization and supply chains, that's really closely related to commodity prices, has a big impact on FX risks, and ultimately that actually influences central bank policy as well. So there are a lot of interrelated processes that in totality might mean that we could find ourselves living in a higher interest rate environment for longer.
Okay, super clear. Thanks for that, Stefan. I'd like also to liaise it with multiple recent surveys that are going out lately. They all seem to be indicating that cash flow forecasting and working capital management is at the top of the agendas of CFOs and treasurers. What are your thoughts on that?
Yeah, I think that's totally unsurprising given what we just discussed. Forecasting is to an extent a prerequisite to efficient working capital management, because unless you understand, what demand you're likely to face, when exactly your different cash inflows are going to take place, and also when you should expect your outflows to take place, it's very difficult to put processes in place to manage that in a kind of optimal way. I think we noticed a couple of interesting things on the forecasting side of things. So you're right. If you ask a treasurer or a CFO about this, they tend to agree that it's a top priority. There are also some surveys which suggest that at the same time, many CFOs and treasurers consider their own organization to actually be very good at forecasting. Indeed, we read a recent survey which suggested that between 70 and 80% CFOs consider their own process to be best in class. And I think it probably makes sense to a large extent, especially if you think about slightly larger companies, because traditional forecasting is actually a pretty well understood process, in my experience, and many companies have done pretty well at mastering that. And I think that the next step is is really to kind of think about how forecasting feeds into broader working capital processes as opposed to being a distinct field.
So what do you mean by that? Like, as a distinct field, do you see like a specific department dedicated to that?
Well, yeah, it's something we spend a lot of time thinking about here at Ayora. So if you think about how this is being done with the companies today, forecasting is seen as a kind of distinct process within the treasury team that people undertake. What we're quite interested in is, instead of looking at it as a slightly separate question, is can you actually, for example, feed forecasting to be just a feature of a process? So to give you a concrete example, there's more and more talk about the objective-based forecasts, which form an integral part of, for example, like a smart AP system that essentially undertakes certain forecasting activities in order to achieve a very specific goal that it does, as opposed to creating a forecast for a general purpose.
Okay, so the survey you mentioned, Stefan, I'm interested into having a look at it. So we'll put the link in the description so people can actually consult it, because that's very good insight. And yeah, overall, people want to know where their money is, right? That's more
absolutely.
That's more or less the idea. Yeah, makes sense. So what are the solutions out there on the market that can help corporate treasurers in the management of their working capital? What's out there right now?
Well, the tech landscape is evolving. There are actually a number of interesting solutions out there. Many of them are kind of predicated on what we call kind of seamless execution. So oftentimes that means that these are essentially payment systems which help to move money either in or out of a company. And this is a space that has seen a lot of evolution. There are a number of kind of incumbent players in the space, but you also have an increasing interest from upstarts trying to disrupt these different kind of subdomains.
Okay, and could we call it enough? Like, is the offer out there able to support the requirements of treasurers, but also I'd like to say the evolving needs and requirements, right? As per those priorities that we just broke down. Is it enough?
Well, it's certainly helpful, and many of these tools they're a great job at what they're designed to do. But I think it also depends on how you kind of want to look at digitalization within working capital management, because working capital management is not just about execution. If you think about payments, that's actually just a culmination of a much more intricate process that takes place in order to get money moving from one place to another. So, we think that if you're trying to find areas where more value can be extracted within working capital, I think a lot of that would be around process discipline and controlling that discipline within companies. And increasingly technology might be deployed to this end as well. And the smarter it gets, the more helpful it can be at helping people to effectively deal with processes in an increasingly agile way.
Do you think those solutions are coming from the traditional players in the market, or do you think that it's really the fintech and younger, maybe not the younger companies, the new companies are disrupting it? Or do you see those solutions provided in the existing providers?
An interesting question. I think there are existing providers that have done a good job. And, there are some quite impressive companies that maybe a few years ago would have been called a startup, and these days they're kind of becoming increasingly seen as incumbents. But inevitably, there's a lot of scope to kind of improve things, but also just approach things from a slightly different perspective. And I think that's what a lot of younger companies are doing, is they're trying to take some of these business models, find areas where perhaps there's scope for improvement, and for just making it more suitable for the way that you work today as opposed to 10 years ago.
So what are those? Can you give an example of like the kind of methodologies or tools that were typically employed for working capital management and treasury departments, which perhaps now are less easy to use or less effective, or archaic even?
Yeah,
what tools are those?
I think if you kind of look at those situations where people try to make incremental improvements through a kind of pre-existing technology, accounts payable systems are a good example of that. So, 20 or 10 years ago, people were trying to essentially digitize a process which used to take place across email, Excel spreadsheets, and the like. Today, people are thinking to what extent these processes require nearly as much human input as they did 5 years ago. And so people are asking themselves questions about to what extent is human involvement here useful? Is this a case of further digitizing this, or is it actually a case of just automating it away? And conversely, I think that leads to the second question, which is where's human time best spent? And oftentimes that's around managing processes which kind of come before this execution side of accounts payable. And that's where we see probably a little bit less kind of pre-existing activity and pre-existing providers in that space. But we expected this probably going to only grow.
Being Corporate Treasury 101, and I think conversations so far has been quite non-101, which is nice as well. And your accounts payable systems, if we just break that down for a second, because it's interesting that you say that that's really one of the big opportunity areas, is typically inside a company, you would have like an admin sitting and like really paying all the invoices to all the suppliers manually, meaning logging into a bank account, putting in the details of the receiving bank account, and then clicking send, right? Is that those are the kind of processes you're talking about? Is it as basic as that, or?
Yeah, pretty much. To a large extent, it boils down to exactly that. There's, a little bit more work to be done than purely logging into bank account portals. You'll find that account payable teams often kind of manage the entire process of ensuring that invoices are legitimate and that they also are as they should be in terms of structure, amount, and so on. And I think what you then find is, to what extent this, for example, verification and governance function of accounts payable is necessary versus, for example, this kind of simple execution side of it, where you just click a number of buttons to make a payment. I think people increasingly argue that the governance side is naturally sitting with people, whereas the side of logging into the bank accounts is perhaps less, because there's just less kind of value being added in those final activities, if you like. But I think, the kind of second interesting question that many people ask themselves, if we stay on the accounts payable topic, is, how often do you have to do this? How often can you process invoices? Many companies will kind of organize their payment activities into what they call payment runs, when they execute a lot of kind of payments which are due around a similar time, let's say once a week, maybe only a couple of times a month. That inevitably leads to situations where you might end up paying something a little bit earlier than it's due. So it's a good example where technology can step in and help people sort of schedule payments, of which there could be many thousands in many cases, at exactly the optimal date, which again comes back to the point of maximizing cash on hand and effectively reducing your financing expenses.
So what I take from all this, Stefan, is that some companies, and I mean, I can only concur with that, some companies are quite far in the automation process, digitization. Like, we are still at the very early stages of this for certain big corporates, even that it seems very manual, very human-based. So I know there are some steps between this and what I would like to talk about, but I need to ask the question though. There is a kind of a trendy topic lately, to say the least, which is AI, artificial intelligence. If we look at really the best in class working capital management processes, systems, and companies that execute that the best, what could be the role of AI? And if we are like 20 years from now, where everybody has streamlined their processes, optimized them, and so on, Where does AI fit into all this?
Yeah, we see this as a very exciting space. I think if you asked me 24 months ago, I probably would have told you that it's largely around automating some of those kind of more repetitive processes, like, for example, scheduling payments at the right time. But I think the technology has advanced so much, and also the people's responsiveness to it and willingness to adopt advanced so much that we can imagine a future where AI can actually assist people with all sorts of decision making that goes into managing working capital well beyond, very simple administrative processes. And we think that, for example, there are very exciting applications for AI in helping people to make sense of all the different sort of data points that they receive as part of working capital processes, and finding efficiencies or inefficiencies that might actually not be apparent to them at all. So we think that AI, could be deployed to effectively become a process enhancement tool as opposed to being a pure automation tool, because probably in the near to mid-time future, we will still have a significant human element in all of these processes. So we think that the space is actually vast.
How far away you think from a Minority Report working capital management kind of processes where you just have to put on gloves and we can, touch holograms and forecast everything and have working capital management enabled through this? Probably a bit far still.
Chances are, a lot of this. One thing to kind of also bear in mind always about working capital is that it's always a two-way process. You always have someone who is the supplier and someone who is the procurer. So to some extent, there will be limitations as to what can be achieved on one side if the other isn't quite as technologically advanced.
No, a lot of sense. So overall, if we had to look at the future of working capital management, but let's be a bit more realistic than Minority Report, in the short, midterm, like 1 to 5 years, let's say, what will be the solutions out there that we'll be able to find to help corporate treasurers and CFOs, help them with their priorities, right?
Yeah, I think it's probably going to be twofold. The solutions to automate some of the processes that are appropriate to be automated will probably become more prevalent and easier to adopt. And I think also we will increasingly see people deploying technological solutions to essentially help with more of a, say, strategical or at least tactical decision making, where those decisions cannot be simply automated.
Okay, so overall, maybe to wrap up on this, what is working capital management and what are the solutions out there? So working capital management is about maximizing cash flow, right? By optimizing your AP and AR processes and making sure that everything around it, inventory management, human resources, whatever that is a cost center, but also the revenues, this whole thing is optimized. Is there anything else that we didn't mention and you'd like to mention in regards to working capital management and the solutions out there right now?
I suppose the one topic that we haven't spent as much time on is the kind of working capital financing side of the equation. There are solutions to help you accelerate your cash conversion using financial products. It's a very interesting space, but it's perhaps slightly less directly related to what we're trying to do at Ayora, which is to support people with organic cash generation.
So that will be the perfect transition. But I guess where you want to position yourself at Ayora is just before that supply chain financing and working capital management financing. Yeah, super clear.
Exactly.
Sorry, can I ask a question a little bit going back to the AI conversation? Stefan, you mentioned something interesting, which was like, and indeed, like this is something that as I learned about AR and AP, you kind of realize that someone's AR is another person's AP, or in the whole supply chain of whatever it is you're delivering as a good or service. If you had like two AIs, like an artificial intelligence on the AR side and another one on the AP side of that same transaction, and you're both optimizing for whatever you do, like couldn't there like be a, I don't know, like a singularity moment in that, like where, I don't know, both of them like optimize down to an instantaneous transaction that's good for no one, or I don't know, like would the whole world just blow up if that happened?
Yeah, you're right. There's definitely a competing tensions in these processes, and what you often find is that this is to a large extent down to the kind of, let's say, power dynamics between the two actors. So what you find is that sometimes the attractiveness of things like payment terms or billing terms becomes just part of the value proposition that you're selling as part of your solution. So you're right. It's to some extent it's always going to be a set of trade-offs, and I think that's why it's also important to remember that it's not quite as simple as just automating processes and being done with it, because it is much more nuanced oftentimes than it might look like.
Yeah, I mean, Guillaume, you always made a point when we were talking about this in our previous episodes around leverage in your supply chain, right? Do you have the leverage, the scale to be able to negotiate favorable payment terms for yourself versus others in your notes? Can the AI negotiate one day? Like, can two AI guys negotiate with each other and come out with a favorable outcome? Because in human interactions of negotiating those kind of things, it's kind of like, okay, one for me, next time for you. We build trust, we build relationships, and therefore we're able to have those, these things foster relationships almost as well, especially in your customers and your clients.
I want to witness that conversation if it ever happens between two AIs. Even though that might be at supersonic speeds, might be interesting.
Yes, it would be interesting to see the arguments that are being used.
Gordon, you're the technical guy in the team. Do you think that you can code in parameters for AI negotiations and leverage?
But it depends if you're talking about narrow AI or
Within AI,
more general AI or deep AI. So initially, these things would probably be constructed with narrow AI. They'd work within a set parameters. There may be some negotiation in there that some leeway that it can work towards, but then it would just back off if it hit that threshold. Whereas with more kind of deep AI that would be driven by a real-time learning algorithm that was seeking reward, for example, what we call reinforcement learning, which we might touch on again a little bit later, which, for example, Google DeepMind wrote a really interesting paper that they published that, reinforcement learning, this idea of seeking reward and being punished by penalty, is what drives, the entirety of learning across, biological organisms. So if you're dealing with that, where it's constantly trying to seek the most reward, it really depends on what kind of, first of all, the policy that's been set for it. So what can it do? But if that's unconstrained, if it has no limits that have been built into it, then it really will just seek the maximum possible reward. So if that involves essentially getting one over on the other party, then it would really come down to who had the better reinforcement learning algorithm between those two parties when those two AIs are working, against each other. So yeah, it'd be very much like a game. So yeah, it's a very interesting idea.
There's a really interesting story on reinforcement based reward systems, which is like they did the same thing with football robots once, right? And it's interesting because when you code those kind of problems, you need to be very careful with what you reward. So in those football-based robots, they rewarded like scoring goals and things, but they also rewarded touches on the ball. So if you're able to touch the ball, or what they meant to do was passes, but they coded as touches. And these robots were just sitting there, just kept the ball in front of them and just kept touching it like this to like max out the reward system. So I guess it can go wrong as well if you don't set it up correctly.
Absolutely, yeah. And I think it'll probably be a big stimulus to really bringing in regulation as well. There'll be some kind of safety event in some industry where this will just get a bit out of control. Someone will code it incorrectly, for example, in some way, and we'll have a weird, hopefully not catastrophic, but there'll be some weird kind of event where it becomes there'll be some kind of unfairness in the system that will require regulation.
I agree, and I think it's the other interesting topic when it comes to working capital management is there are certain circumstances in which companies might actually self-impose certain limitations to how far they will go. I think a kind of commonly quoted example of this is management of like essentially your payables and stretching out payment terms. Which you'll find is that large companies, which theoretically should have a greater negotiating power, often have worse DPO metrics than smaller companies, and that's actually most often due to the fact that those large companies don't want to be seen as unfairly stretching payment terms on their own supply chains, which might have a lower negotiating power. That comes back to kind of people's perceptions on corporate behavior and treatment of your various stakeholders. So whilst financial efficiency is a big driver, you will find that working capital has more facets to it than just that.